In this video, I wanted to have a quick look at the financials of JDE Peets because on the 22nd of February they recently released their 2022 annual reports. Now JDE Peets is quite a new public company. They initially IPO'd in 2020, so there are not that many financials to cover. So this video will be rather short. Now JDE Peets is a manufacturer mostly of coffee and tea brands. And I actually have a tab with their brands open right here so you can have a quick look. Douwe Egberts, Kenco, Peets, Law, Stumptown, Senseo, Jacobs, Pickwick, mostly coffee and tea brands. So let's just dive right into their financials. So in 2019 they posted a revenue of 6.9 billion, which has been increasing to 8.1 billion here in 2022. A record year in their 4-year streak. This gives me a growth rate of about 4%, which is quite nice for a consumer goods giant like JDE Peets. Adjusted EBITDA, or actually no, sorry, I should say it's adjusted EBIT because there's no depreciation or amortization involved in these numbers. Their adjusted EBIT is 1,255 here in 2019 and 1,227 in 2022. Now, even though their revenue has been growing, their adjusted EBIT has been coming down. And this very much shows me that their margins have been decreasing. Now, of course, there can be a multiple of reasons for this. It can be that the price of labor has increased. It can be that the price of the raw goods has increased, which I think both are true. So even though this does imply that their margins are shrinking, maybe there's a macroeconomic reason behind this and not so much because they are not efficient in running their business. Because I think they are efficient when I look at their cash flow and capital expenditure later down the line. But just looking at these numbers, we can see a decreasing EBIT number. Now, their debt level has been coming down. They have been really deleveraging as of recently, which is very nice to see. Now, as we'll see in a little bit, they have quite some cash flow. So, of course, there's many things they can do with that, and paying down debt is one thing. Excess cash on hand, not really much to say here. This number hasn't really moved. Market cap has been decreasing. So the initial IPO price was in the 38 euros and 50, and it's been coming down after that. Enterprise value is the entire value of the business. Now, let's see, I should probably actually remove this number because this does not include a market cap. So looking at the market cap, we can see that the market cap has been decreasing by 10% every single year. They started with the initial IPO of 38 euros and 50 cents and it's been coming down. Same goes for enterprise value. The enterprise value has been coming down because of the market cap coming down mostly. The EV/EBITDA ratio has been around the 15 times mark, which I think is relatively high for a company that doesn't show as much growth in their earnings as of yet, but they might just show that in the future, so I think this might be relatively fair. Net debt to EBITDA, they do have quite some debt on that balance sheet, which is very much why they needed to delever their business, which may also very much be why they decided to go public in the first place, so they can use the initial cash injection to pay down their debt. I very much would like these numbers to go down because I do think they are in the risky territory of beyond the 3 times ratio, which is also the ratio that many investment banks will use to determine whether an asset is risky or not. Now, of course, it does have to be noted that I'm looking at EBIT here and not EBITDA. So the depreciation and amortization have reduced this number already. So I actually think the actual net debt to EBITDA level, so not EBIT level, is around the 3 times ratio. But still, I would like to see them decrease this number. Looking at cash flow, we can see it's been increasing a little bit. 2020 was a bad year. 1600 seems to be the norm here for the past 2 years. Capital expenditure does not seem to move at all. They do not increase their cost, they do not decrease their cost. They are very happy in the position that they're currently at. It also implies to me that they're not really striving for growth that much, because otherwise I think I see some more fluctuating numbers here. I think these are really just the costs that they are making to maintain their operations. So this then brings me to free cash flow, which gives me a very, very lovely number here of cash flow minus the capital expenditure. Now, of course, they also have to pay down the interest of their debt level. I do not include this here. I do not include this into the cash flow. Neither do I include debt payments, because they have been doing debt payments here for the past few years. These are not included into this because I just want to look at the actual operation of the business. Shares outstanding. Initially they IPO'd with 498 million and they reduced that to 485 million already. So they've already been buying back shares. Free cash flow per share has therefore been increasing quite a lot because, well, we see here that the free cash flow per share has been 16% and free cash flow has been 3%, but this is because the free cash flow also very much involves this number and doesn't take the 900 as a starting point, which the free cash flow per share did. So I think this number is a bit painted, and I think 3% is probably more accurate because this number seems to be a bit low because their cash flow this year was relatively on the lower end. So, like I mentioned, they initially IPO'd at €38.50 on the 29th of May 2020. Now, this price has already been coming down since their IPO and has been coming down to €27 here in 2021 and also €27 in 2022. Giving me a cash flow yield on average of 8.5%, where I think the market is kind of having the consensus that 10% seems to be the overall average number. So trying to project this company into the future is a little bit tricky because of course there's not much data to go on. So a lot of this will be based on speculation. Now looking at the EBIT numbers, they have been decreasing for the past 4 years by about 0.6% every single year. Although I also have to say their revenue has been steadily growing, and I think the reduced EBIT is mostly because of the additional macroeconomic impacts on their business. So I actually expect their EBIT to increase in the future, as is their revenue, as they're able to regain that this profit margin. So I'm going to give them a 1%, which I think is a relatively conservative estimate here. I'm going to give them a 1% EBITDA growth every single year, starting with the year 2022. I'm looking at a market multiple here of 13 times because I think this is the number that the market have kind of settled on for the past 2 years. Of course, the initial IPO, after the initial IPO, there's a lot of speculation and price movement happening until the market decides on a price that they actually want to pay for this business. And it seems that for JDE Peets, this multiple has been at around a 13-14 times ratio. I'm going to say 13 because I want to be more conservative. This gives me an enterprise value 10 years from now of 1.7 billion, from which we subtract the debt, we add the cash, gives me a market share of 13 billion, divided by the amount of shares outstanding, and I'm going to remain at this same number because I'm not sure what's going to happen in the future. They do have a lot of free cash flow, and they are using this cash flow to pay down their debt, buy back shares, and do dividends. They do everything they possibly can with their cash flow apart from expansion. So I actually do imagine that the share count will reduce in the future, but I'm not sure whether that is true or not. Based on the information I have right now, I'm going to leave it at 485. Gives me a stock price 10 years from now of €28.25. Now for free cash flow, I'm going to do a relatively similar thing. I'm going to take the number here of 2022 and I'm going to grow it by 3%. And I'm going to grow it by 3% because this is the average growth number that we see here historically. Now add to this that they might also very well buy back some shares, which will increase this number because of course the denominator decreases, so the overall number will increase. But I'm going to remain it stable at 3% for the first 4 years, then I'm going to reduce it to 2% for the 6th year after that to give a relatively conservative estimate here. I'm taking a free cash flow yield of 10%, which is the number that the market has decided on for the past 2 years, and I think that's a nice and conservative number. This gives me a stock price 10 years from now of €35.73. Right now on the open market I can buy as many shares as I want for €27.48. Taken our two projections into the future, I get an average share price of €31.99. Now simply looking at the price on the stock market itself, I expect a compounding annual growth rate of 1.5%. But of course what we see here is that JDE Peets is a cash flow machine. They produce a lot of cash flow, and this is very much what you're investing in when you invest in JDE Peets. You don't invest in growth because they aren't really growing. They are not investing into growth. The capital expenditure is very minimal. They just produce all the cash flow every single year and use that to buy back the debt, buy back shares, and pay a dividend of 35 cents every half year. So this is what you're investing in if you invest in JDE Peets. So this gives me an IRR 10 years from now of about 15%. I always say on average the stock market returns about 10% every single year, and I think when it comes to that, JDE Peets might be beating this number. But of course I'm only looking at 4 years of data, it's not that much information to go on. So this number might not be completely true. I do think their free cash flow is very high for a company as relatively small as they are. So I think these numbers might actually take a hit as well in the future, and these might be a bit more inflated, but I'm not exactly sure. There's not much data to go on. So I'm just going to assume that these numbers are completely true and accurate of their business model, and I projected that in the future. So let's see what happens if the price goes up or comes down. Now, the moment that the price goes down by even 10%, I expect an IRR of 17%. And the moment it drops by 20% to 22 euros, I expect an IRR of 20%. This is a very, very attractive IRR with, I think, a relatively accurate future projection. It's not really that conservative. I think the conservatism is minimal here. I think the multiples, as well as the yield, as well as the future growth, are quite accurate as to what I imagine this company will do in the future. So the moment it drops down to 22 euros, I'm going to be very interested in this stock. So this was JDE Peets. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff. And I'll see you in the next one. Cheerio!